Hello, Josh. Good to see you.
Yeah, good morning, Richard. Good to be back.
Everything going all right?
Yeah. Happy Thursday. I think I mentioned this offline coming in here, but I traveled most of the week. 4 out of the 5 business days last week I was in the air, which sounds miserable, but with what we're going through here, just noise and market wise, it kept all my notifications off my apps. It just kept me out of the noise. And
Yeah.
for some reason, I feel refreshed coming into this, man. I feel good.
I actually thought about for the first time seriously, like giving up my mobile phone. It was a brief thought, but
Completely, or just going to the flip?
Yeah, like going to a flip phone or something,
Totally, man. Yeah.
Our attention is precious.
Yeah. Well,
And
drastic times.
it's being moved, you know. So I'm trying not to have to get to that point, where you have to burn bridges, but man, it can be quite debilitating.
Totally,
So,
man. Yeah. Crazy
absolutely. We
times
have to
calls
have
for
times
crazy
that we're
actions.
unplugged. We got to have
Yeah.
times to unplug.
Let me I'll get the ball rolling. I know we start every week like this, though I typically don't give a screenshot update of the markets during my little how are you feeling temperature check. So let me show you this just so the
Okay.
folks kind of know the noise that I'm talking about avoiding. This is the type of stuff that we're seeing over the last, as you know, 30, 60, 90 days. S&P 500 down 20% year to date. I can crush through the rest of these. Bitcoin hit 2022 lows, down more than 60% year to date. You could see up in the top right here, it's almost 18,000 at this point. Ethereum almost dropped below 1,000. It's down 70% this year to date. Are we in a recession yet? Or the better question, how are you feeling? I mean, anything on your mind this week?
I think it's very discouraging that we haven't had even a good bounce yet. I mean, last week there was 6-7% bounce, but we're down again this week. Doesn't look good. And I think that, I mean, I've been saying I think this is an 18-month minimum. I think the 73, 74 market is probably our best model, which was an 18-month correction. And, it was close to a 50%. I think 48%, peak to trough. So that's the model I have in my mind. And, doesn't mean that's going to happen. Ultimately, we have to position ourselves for what we believe, kind of hedge in the direction of our beliefs, but respect, the independence of the market. The fact that, we could be wrong, right? One of my favorite books is, or book titles, I should say, is Being Right or Making Money. You want to be right or you want to make money? Making money happens with good risk management. You hedge in the direction of your beliefs based on your time frame, and your risk tolerance. But if you just want to be right, you're not likely to make money. So that's just my caution. I'm basically positioning myself for an 18-month, 50% correction. And I think we're about halfway there.
There's going to be a couple questions today that I ask you to sort of double click or unpack that a little bit. As you can imagine, as I'm aggregating questions for this, just from listeners and folks that follow us, this is where most of the questions hover, is how long is this recession supposed to be? What should we expect? What asset classes are you looking at? Things like that. Before I get too far down that road, and I do want to explore that with you today, let me just talk about maybe one or two other warning signs, and maybe you help me unpack those a little bit of just where we're headed. This is from Monday. If I can share my screen again. Boom. This is from Monday. Fed Chair Jerome Powell mentioned, this is back in May originally, mentioned that we were expected to see 50 basis point increases in both June and July. On Monday, it was announced that we were going to see a 75 point basis increase. Powell called this, as you can see here, an unusually large one. I think he said we may see one more like this here before the end of the year. I think this headline is scary, like unusually large. We're expecting 50, here's 75. But to the layman, just to be frank, I struggle to understand what does this really mean? And so I'm hoping two things here. You could help me understand, what does this increase, this rate increase mean for us as just the retail investor or as the average American? And then the second piece is, if we were expecting a 50 basis point increase and we get a 75 basis point increase, that gap, what does that do to us? Like, is that as serious and scary as it sounds here on paper?
The biggest thing that it does to you is it hurts your market-based assets, because the market that we're in right now, or the markets that we're in, are really Fed markets, right? So we don't really have free markets at this point. We have markets that are responding to what the Federal Reserve is going to do, okay? And that's been going on for at least 20 years now, back to Greenspan and the post, internet bust, right? The dot-com bust and 9/11 and those kind of early interventions that were kicked off by Greenspan and then embraced, in the financial crisis, and then after the financial crisis, and then with COVID, et cetera. So the Fed has been intervening in markets for 20 years now, and the markets have basically come to believe that the Fed is the biggest driver of the markets. I think that's a very problematic belief, ultimately. I don't think that the Fed should be the drivers of the markets, but that is the market's perception. Everybody knows that this is like over leveraged and overextended. And so everybody's just saying, can the Fed hold it together or not? Or is this thing going to fly out of control? And, those kind of rides that you go on at the fair, where you're kind of buckled into the perimeter of the Ferris wheel like thing, right? And you're spinning around and you can feel like you're going to fly off, but something's holding you in there together. Well, that's the Fed kind of pretending to be the force, that can hold it all together so it doesn't all fly apart. And I don't think that they can do that. I don't think they should do that. But basically what you're seeing is when, I said, they're giving forward guidance. They're trying to be transparent. They're saying, 50%, 50 basis point raise in the Fed funds rate is where we're going to be. But then it turns out, we got to respond to data. And now that inflation data was too hot. So seems like a 75 point raise is what we need, right? So the market's freaked out for a couple of weeks, but then when we actually got to the announcement, the markets rallied on that day, right? So it's all just a game of expectations management right now, which is not what markets are supposed to be. Okay, it should be very, that to me is the most disconcerting thing, because I don't believe the Fed has credibility when it comes to markets. And I think more people are coming around to that view. Okay. So I don't think the Fed can hold it together. And I think that's why I think it's going to be, worse before it gets better, because we have to let go of that, centralized, controlled markets. And that's going to be a painful process. So
this idea of like it's going to get worse before it gets better, I think we've hovered around that a couple times over the last few months. You mentioned here earlier, this could be an 18-month, sort of trough here that we're dealing with,
or
potentially.
Worse.
Yeah, or worse.
I was just looking, the biggest expansions in history, 2009 to 2020, right? Coming out of the Great Recession, I guess they called it, from June 2009 to 2020, it was like 120 months of expansion or more. Maybe it was 140. It was like 12 years, 12 times 12, 144. It's the longest expansion, in economic history. I mean, I think the average before that was maybe 60 months. So, and much of that expansion was driven by an interventionist Federal Reserve who wouldn't let the markets correct. So if that's where we're at, that we had an engineered largest, financial expansion in history, the flip side of that could be very painful.
Yeah.
And a lot longer than people think.
When, if you typed in like recession into Google right now, there are, too many articles about the fear of a looming recession.
Yep.
And me in my young investor days, like I've not dealt with something like this. The closest thing that I could think about is amidst COVID. And we had this like black swan event where the market saw this dip and then it was an immediate skyrocket. Everything recovered. And it was like, all of a sudden everything's at all-time highs and it was immediate. This does not feel like that. And my zoomed out question, just for those of us that are experiencing this for the first time, is when are we officially in a recession? Like if I ask the definition of a recession to Google, I just see 2 consecutive quarters of declining GDP. Is that as simple as it is? And we have to wait until September to see when they release, what is this, Q3 or Q2's GDP? Q1 was negative 1.6. We've got to wait for Q2 and then we know we're there, or can we maybe call it?
A lot of people think we're in a recession right now.
Yeah.
But actually there's it's called the National Bureau of Economic Researchers. This is a private think tank group, and they're the ones that officially say whether we're in a recession or not. So they keep a pretty interesting history of kind of economic cycles. And they say, based on half a dozen things or so, and a committee which looks at the data, whether or not we're in a recession or not. So they actually, usually a recession is 2 quarters as kind of a rule of thumb. But during COVID, February to April of 2020, they called that a 2-month, recession, right? Peak to trough. So that was, hadn't, been done before, but they looked at the total weight of, economic indicators, and, it's an extended and deep period of economic contraction. Basically it, and they look at unemployment, they look at payroll, they look at about half a dozen things. And then the committee decides whether or not this was officially a recession or not.
Copy.
So
the number one most submitted question, and this is not just between this gap, the question, I'm not sure if I like the question, but it's submitted so many damn times, I've got to ask it at this point.
Okay.
You talked about this is going to be an could be potentially longer, 18-month recession. We could see something like a 50% cut. And this is all just using historical data, and we're just talking at this point. The most submitted question is, how long is this going to last? And if I sort of give you a sub bullet to that, I mentioned my rookiness in the investing markets. You've been in it a little bit longer. You've seen a couple of these dips and been able to work with things like this. Maybe just your investing history. Maybe it's your study of cycles and markets and just your day-to-day activities. Can you share with us, if there's a calculation or how you're getting to this point? 18 months. I feel like that's a nice little date to circle out there and say, strap down and guys, just man up and gear up for 18 months. How have we gotten to that point? Can you just maybe help us understand this a little bit more?
I'm looking at how long contractions have lasted in the past, right? And I'm looking particular at kind of 1973-74 contraction as being the one that's most historically analogous to the environment that we're in right now, which is potentially a stagflation environment where you have inflation and, a reduction in economic growth. So that's kind of where I think we're at as an analog. Okay. And I just think 18 months at least, gets people's thinking out of this trap of, is this the bottom? Right? Because people are still thinking that way right now. should I be backing up the truck on, Tesla right now? Should I be backing up the truck on Bitcoin? No, these speculative assets are long-term opportunities. It's really an incredible opportunity for people like yourself, Josh, because look, if you're dollar cost averaging month to month, over the next 3 years, let's say, and you don't, you're then thinking about a decade, 2 decades of, growth opportunities after that for the next expansion cycle, should be excited, man. Like that's the right mindset here, not like, when do I pick the bottom? Oh, it's gone on so long and man, can't go further than this, right? Bitcoin's already down 50, 60, what is it? 75% now, it's got to be a bargain. Used to be 68. Now I can buy it for 18. Woohoo. I've probably said this before, but you know what they call a stock that's down 90%?
What's that?
It's a stock that was down 80% and then fell in half. Okay. So if Bitcoin, went from 70,000 to 18,000, and that's 80%, I don't know if it is or not, right?
Sure.
But for it to be down 90%, right? It only has to go down another $8,000, let's say, right? But that's 50% from where you bought it at 18, right? So that's what people have to understand. It's a totally different mindset than, the go-go markets of 21, right? This is not momentum, chasing. This is not Ponzi schemes, this is about how do you position yourself for the next couple of decades. And so that's the thing that I just would encourage people to be adapting their mindset to a totally different environment than you've ever experienced before, and expect it to be longer and deeper. I'm not out of the markets totally, right? I'm still long my core portfolio because, I'm thinking that's 10, 15 years down the road, right? I did definitely lightened up at the end of 21, right? I talked about it. I said, I want some powder dry because I think this is crazy what's going on right now. I want to sell into strength and buy into weakness. And, it's not a bad time to start a little buying process here because, we could get a V-shaped bottom that could take back off and the Fed could engineer a soft landing. I could be wrong. I don't think so. It's not how I'm betting, but I'm also, not running for the hills and, putting everything in cash.
That was the number one question was, how long is this going to last? You just hit on the second one there. And I don't know if I want to be that. If you're comfortable answering this, I'd love to hear an answer of what's on your watch list. But if you're not comfortable with that, of giving exact tickers or asset classes, that maybe a second question is, we are at a point where those of us that have longer term horizons, and if I'm thinking, like you said, decade or decades out, this is a really exciting time where things are much cheaper or at a discount than they were 2-3 years ago, and we could be getting involved in things. My question is that at that point, what would we get involved in? And if, like I said, if you're not comfortable answering that directly, and what are you watching, the Teslas, the Spotifys of the world, maybe just help me understand what we could be looking at, or the asset classes we could be taking a look at.
Thesis is that we've been living in a financially engineered world for 40 years that was facilitated by lower and lower interest rates over the past 40 years. Okay. So the cost of money kept getting cheaper for 40 years. I think last time I used the metaphor of, if you had bought a house 40 years ago, right? And you didn't do anything to it. But it kept increasing in value because all assets were being inflated, and you were able to refinance it at lower and lower rates. So your payments, got lower and lower, and your principal got lower and lower. But the house, is in bad shape. So our house, our financial house, is in bad shape right now. Our economy is in bad shape. There's serious supply chain issues. There's, the war in Ukraine. And all of that is on top of a neglected infrastructure, neglected, rubber meets the road economy, right? So whether it be power distribution or food production, all these things that, that we forgot were necessary to survive, because we all thought we were going to just live in the metaverse, and play games for the rest of our lives, are in need of development, repair. So I just, I call it the embodied economy or the analog economy. I'm just thinking in terms of things like energy, food production. I think there are, some serious technology opportunities over the next 10 years. But, the technology investing that was going on in 21, that I talked about repeatedly as being misleading, right? We got to get out of that mindset, yes, figure out, maybe it's biotech, maybe it's robotics, but you got to be thinking in terms of a decade, at least, and you probably got to find somebody who's really digging into technology companies, because, that we don't have the time. We got jobs, so, find a good technology newsletter, right? Somebody you really trust, and, or go into your field. I mean, you're in cybersecurity, right?
Yes, sir.
So probably see opportunities there. You understand the space a little better. So I just, again, the investing, you can't even call it investing, the speculation and Ponzi schemes that were going on, from coming out of the COVID V bottom up until basically, fall of 21, that mindset's got to go. That's gone. You got to go deeper.
One of the your approach to mindset is one of the things that keeps me coming back. Like it keeps me out of my own emotions. And I started with, you on my podcast, then I had the chance to take your 7 principles course. I've gotten involved in your app. I'm talking to you on a bi-weekly basis. My question to you is, you've helped lots of folks remove the emotion from investing through this new lens that you've placed in your app. And I've been able to see that in motion several times now. And one of the more recent ones, or one of the cooler opportunities, was back in, I think it's February or March of this year, where I saw you and Justin, the co-founder, you guys got together on a Zoom, and in I'm giving you too much time. I think it was less than 40 minutes. You had built a perfectly uncorrelated, I think we called it a holy grail portfolio of stocks that you had aggregated, tickers that you had aggregated together. And we were tracking that against several of the other indexes in the market, and just seeing sort of the amount of risk involved in each of these portfolios, the movement that each of these portfolios was doing. It has been probably 3 months since I've asked about that portfolio, and I showed the all these different tickers, and the down and to the right and the red at the top of this call. I wanted to see if maybe we could just get a temperature check. And I'm expecting losses, but I'm curious as, what does that seem, and how are we doing on that? And would you be comfortable sharing anything about that portfolio and what it's done since?
Sure. I mean, look, it's done better than the market, right?
Yeah.
It's got losses for sure. Let me see if I can pull it up here, actually.
While you're pulling that up, Richard, I mean, I don't want to spoil something or let the cat out of the bag, but I know that here, sort of behind the scenes, we've been working on, I'll call it an update or a new version of this, and we've gone through some recording processes and things like that. Am I speaking too fast here and letting the folks know that I think there's another one coming down the pike here as far as this course or this opportunity?
Yes, we are definitely expanding on the 7 principles investing course that we did last year. And, that was kind of a pilot project to see how it went, and it got an incredible response. So we're polishing that up and getting ready to launch it on a major video learning platform. So that will be available soon. Thanks for asking.
Yeah, of course.
And the app is really coming along too, Josh. This is a cool, you probably haven't even seen this yet, but we now have a grid view here, as well as this kind of card view. But you can see here, this is the portfolio that I think we talked about last time, Justin and I built. We initially built it in February, then in March, we looked at it again and we said, you know what, some of these more speculative things, one was Bitcoin and another was MongoDB that we both really liked personally, but they were not performing the way we needed them to. And so we
which by the way is a great example.
Took it out.
I'm sorry to interrupt. That's a great example of you had an emotional attachment to a ticker, but you plugged it into this and that immediately removed you from that and said, guys, this isn't a good decision. Like that's the type of stuff I'm talking about. You've been able to do that for me many, many times.
So here's the portfolio, I'll zoom in on this. This is the growth relative to the NASDAQ or compared the Dow and the S&P. This is over the past year, but if you look back to March, it's about here, right? So it's definitely down a bit, but it's not down as much as these other indices. And let's see what else we can look at. The volatility of, the lower volatility, lower standard deviation here compared to especially the NASDAQ, and better risk efficiency and a lower D score. So it's still pretty solid. The D score is about 1.5, 1.5%. That means, that you should expect your worst day at least once a month to be a 1.5% loss or more. But I love this, this is you can see here what's been really driving, the performance. So we've got some real world, production companies like Alcoa, Medicine, AbbVie, doing pretty well. Berkshire Hathaway, not getting crushed over the past year. Food up 11%. Ford, Floor & Decor, Atlassian, those are down, but they're not down, 80%, right? Gold, Procter & Gamble, and oil up 66%, right? So, balance here, some speculation, but overall, a lot of analog assets, let's say, that people can't do without, that are going to be the core of any economy, whether Mark Zuckerberg likes it or not.
This thing gives me chill bumps, man. It's so slick. Yeah, watching you work in this
coming along, man. I really am. I'm excited about it, and everything's on like a 1-year time frame right now, which is a good time frame. But as we scale it, and you can basically do it on any time frame, look at it over a 5-year or a 5 minutes. I think that's when it really gets unprecedented.
Yeah. I think I say this every time we close, man. There were a couple, I think I'm going to save this. I'm a crypto guy and I had a couple of Bitcoin questions I wanted to ask you, but I think I'm going to save them just so I can close on the app, and there's some cool visuals in there that I'd like to wrap up on. It's an honor to be a part of this, man. Even coming into the chaos that we're dealing with, I come in and I start to feel a little bit level set, and to have access to something like this, that you can see the volatility and the risk involved in a portfolio that we're able to assemble with something like you've put together versus just pumping money into the S&P 500 or pumping money into a portfolio we've created. And it's an exciting time, man. It's an honor to be here. And I appreciate you allowing me to be a part of it.
Thanks, Josh. I love your questions. I love the generation that you represent. And, I really think it is an incredible time and an incredible opportunity. And I hope more people can see it like you do.
That's all I got.
Have a good one.
Have a good weekend.